Most people believe money is about intelligence, about strategy, about knowing what to buy, when to sell, where to invest. But most financial outcomes are not determined by knowledge. They are determined by emotion, fear, greed, status, security. These forces shape far more financial decisions than spreadsheets ever will. Emotion feels invisible in the moment. Your purchase feels justified. Your hesitation feels rational. Your risk feels necessary. But emotion distorts allocation. It redirects money away from strategy and toward relief. Relief from anxiety, relief from comparison, relief from uncertainty, relief from discomfort. A raise appears. Emotion says, upgrade your life. A market dips. Emotion says, protect what remains. A friend succeeds. Emotion says, catch up. None of these impulses are irrational. They are human. But markets do not reward human impulses. Markets reward discipline. The most expensive financial mistakes rarely come from ignorance. They come from reaction. Buying when excitement peaks, selling when fear spikes, expanding lifestyle when income increases, reducing investment when volatility rises. Emotion converts long-term strategy into short-term response. Short-term response interrupts compounding. Interrupted compounding quietly reshapes your future. Compounding demands patience. Emotion demands action. Patience feels uncomfortable. Action feels productive. So most people act. They adjust portfolios. They upgrade lifestyles. They respond to headlines. Every reaction feels justified, but each reaction introduces friction into compounding. The irony is clear. The more emotionally involved someone becomes with money, the worse their outcomes tend to be, because emotional involvement amplifies volatility, not market volatility, personal volatility. Personal volatility changes allocation. Allocation determines trajectory. Trajectory determines wealth. Money without emotion behaves differently. It ignores comparison. It ignores short-term narratives. It ignores temporary fluctuations. Emotionless money follows structure. Income arrives, surplus is redirected, assets accumulate, time compounds. Nothing dramatic, nothing reactive, just repetition. But repetition over decades produces separation. Most people never reach that state because money is tied to identity. Income reflects status. Spending reflects success. Loss feels like failure. When identity attaches to money, emotion becomes unavoidable, and emotional finance becomes expensive, not instantly, but structurally. Emotion increases spending during highs. Emotion decreases investing during lows. Emotion shortens time horizons. Short horizons destroy compounding. Money without emotion is not cold. It is strategic. It separates identity from allocation. It treats capital as a tool, not a signal of worth. That separation is rare, because most financial decisions are not financial. They are psychological. And psychology, when left unmanaged, can quietly sabotage the very wealth people believe they are pursuing. Emotion changes the timeline of money. Strategic capital moves slowly. It accumulates. It waits. It compounds. But emotional capital moves quickly. It reacts. It adjusts. It searches for relief. Relief is expensive. When markets rise quickly, emotion introduces urgency. You feel late. You feel behind. You feel pressure to participate. Pressure compresses judgment. Instead of evaluating structure, you evaluate momentum. Instead of asking what something is worth, you ask how quickly it is rising. Emotion converts patience into impatience. Impatience converts strategy into reaction. Reaction rarely aligns with timing. The same pattern appears during decline. Prices fall. News becomes darker. Uncertainty expands. Emotion demands protection. Protection feels rational. You reduce exposure. You move capital to safety. You pause allocation. All understandable reactions, but markets reward endurance, not comfort. When fear removes capital from the system, compounding is interrupted, and interrupted compounding reshapes long-term outcomes. The pattern repeats across decades. People buy enthusiasm, people sell anxiety. And between those two emotional states, wealth quietly transfers. Not through intelligence, through emotional control. Those who detach emotionally from price movement treat volatility differently. Volatility becomes opportunity. Price movement becomes data. Noise becomes irrelevant. This does not eliminate uncertainty, it reframes it. Uncertainty becomes a condition to navigate, not a signal to panic. Money without emotion behaves structurally. Allocation remains consistent. Strategy remains intact. Time horizon remains long. Those three conditions allow compounding to operate. Emotion disrupts all three. Allocation becomes reactive. Strategy becomes flexible in the wrong ways. Time horizon shrinks. Shrinking time horizons destroy exponential outcomes because exponential growth requires patience. Patience requires emotional stability. This is why emotional investors often feel busy. They constantly adjust, rebalance, respond, monitor. But activity is not progress. Progress in capital allocation often appears boring. Slow reinvestment, slow accumulation, slow expansion of ownership. Nothing dramatic, nothing urgent. Emotion struggles with boredom. Boredom invites interference. Interference invites mistakes. Mistakes compound. Over long periods, emotional interference creates drag. Small adjustments, small withdrawals, small reallocations. Individually insignificant, collectively expensive. Because compounding rewards stillness. Emotion rewards movement. The two rarely coexist. Those who separate money from emotion do not eliminate feeling. They simply prevent feeling from controlling allocation. That distinction changes everything. Money becomes mechanical. Surplus flows into assets. Assets expand over time. Volatility becomes irrelevant. Emotion fades. Structure remains. And structure, when paired with time, is what quietly produces wealth long after emotional decisions have faded. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Emotion does not only affect investing, it shapes spending. Most purchases are not financial decisions, they are emotional responses. Relief from stress, reward for effort, validation of progress. A difficult week ends, spending feels justified. A promotion arrives, upgrading lifestyle feels natural. A friend succeeds, matching their progress feels necessary. None of these moments feel irrational, they feel earned. but emotional spending changes financial trajectory. When income increases, emotion encourages expansion, bigger housing, better transportation, more visible upgrades. Each upgrade becomes normal quickly. Normalization is powerful. What once felt luxurious becomes baseline. Baseline becomes expectation. Expectation becomes obligation. Obligations reshape financial flexibility. Higher baseline means higher required income. Higher required income increases pressure. Pressure reduces optionality. Optionality is the foundation of leverage. Emotion rarely considers leverage. Emotion focuses on immediate satisfaction. Ownership requires delay. Delay feels uncomfortable, so consumption arrives first. The order matters. Consume first, invest later. Or invest first, consume later. Those two sequences produce radically different outcomes. Most people invert the order. Income increases, lifestyle expands, investing receives whatever remains. What remains is often inconsistent, and inconsistency weakens compounding. Compounding requires repetition. Emotion interrupts repetition. A good year encourages celebration. A difficult year encourages caution. Both emotions disrupt disciplined allocation. Celebration increases spending. Caution reduces investing. Over decades, this emotional rhythm erodes wealth quietly, not through large mistakes, through small inconsistencies. Small inconsistencies compound into large differences. Money without emotion follows a different sequence. Income arrives, surplus is captured, assets are acquired, lifestyle expands slowly. This sequence preserves leverage. Assets grow before obligations. Ownership expands before baseline. Optionality increases over time. Optionality changes behavior. When your financial structure is light, you tolerate uncertainty. You negotiate more confidently. You make long-term decisions more calmly. Emotionless money creates distance. Distance between identity and spending. Distance between headlines and allocation. Distance between volatility and panic. That distance is strategic because emotional proximity to money creates distortion. You check balances constantly. You react to fluctuations. You measure progress through comparison. Comparison intensifies emotion. Emotion accelerates decisions. Accelerated decisions weaken structure. Weak structure cannot support compounding, and without compounding, financial progress remains linear. Linear progress feels productive, but exponential progress requires discipline beyond emotion. It requires systems that operate whether you feel confident or uncertain. Money without emotion is not detached from reality. It simply refuses to let feelings dictate allocation. That refusal protects the one thing emotion often destroys: time. Because time, uninterrupted, is the engine of wealth. Emotion does something else to money. It shortens perspective. When decisions are emotional, the future becomes secondary. You optimize for how something feels now, not how it compounds later. A purchase relieves stress. A sale removes anxiety. A reaction provides temporary control. But temporary control often sacrifices long-term leverage. Emotion prefers certainty, even if that certainty is expensive. Selling during volatility creates relief. Spending during success creates validation. Avoiding risk creates comfort. Comfort is expensive in a compounding system because compounding rewards endurance. Endurance requires emotional neutrality. Neutrality is rare. Money is tied to identity. Income signals status. Spending signals success. Loss signals failure. When money carries identity, every financial fluctuation feels personal. Market declines feel threatening. Investment losses feel humiliating. Someone else's success feels comparative. Those emotions create pressure. Pressure accelerates decisions. Accelerated decisions reduce discipline. Reduced discipline interrupts compounding. This is why many intelligent people struggle with money, not because they lack information, because they cannot detach from it. Detachment does not mean indifference. It means separation. Money becomes a tool, not a reflection of worth. When money becomes a tool, allocation becomes mechanical. Income arrives, surplus is redirected, assets accumulate, time compounds. Nothing dramatic happens year to year. No emotional highs, no emotional crashes, just repetition. But repetition creates momentum. Momentum expands asset base. Asset base reduces dependency. Reduced dependency creates autonomy. Autonomy is the quiet goal behind most financial ambition. But emotional finance delays it, because emotion prioritizes feeling over structure. Structure requires consistency. Consistency requires systems. Systems operate regardless of mood, regardless of market noise, regardless of comparison. Emotion disrupts systems. It introduces exceptions. Exceptions weaken discipline. Weak discipline weakens compounding. And compounding is fragile, not mathematically, psychologically. It requires patience longer than emotion prefers. Money without emotion preserves patience. It protects allocation. It allows time to do what emotion interrupts. Over decades, that difference becomes enormous, not because of brilliance, because of restraint, because of distance, because of discipline. Emotion makes money reactive. Structure makes money strategic. And strategy, over long horizons, quietly wins. The objective is not to remove emotion from your life. It is to remove emotion from your allocation. You will always feel things about money: pride when income rises, anxiety when markets fall, comparison when others appear ahead. These reactions are human. The mistake is letting those reactions direct capital, because capital compounds based on structure, not feeling. If your allocation changes every time emotion shifts, your financial strategy never stabilizes, and without stability, compounding struggles to operate. Compounding needs consistency, consistent investing, consistent restraint, consistent time horizons. Emotion disrupts all three. A good year triggers celebration. A difficult year triggers caution. Celebration increases spending. Caution reduces investing. Both interrupt momentum. Momentum matters more than intensity. Small, disciplined allocations repeated over decades outperform large, emotional decisions made sporadically. Money without emotion behaves differently. Income arrives. A portion is captured. Assets are acquired. The process repeats. No celebration adjustments, no panic adjustments. Just structure. Structure does something emotion cannot. It removes decision fatigue. You do not constantly evaluate what to do. The system does it for you. Income to surplus to assets to time. When the system is in place, emotion becomes background noise. Markets fluctuate, headlines change, comparisons appear, but allocation remains intact. That distance protects compounding. Compounding transforms ordinary discipline into extraordinary outcomes. Not quickly, but inevitably. Over decades, emotional finance produces volatility. Strategic finance produces expansion. The difference is rarely knowledge. It is emotional control. Most people lose money during excitement and protect money during fear. Both are expensive because wealth is built in the opposite sequence. Invest during uncertainty. Restrain during success. That inversion feels unnatural, but it is structural, and structure always outperforms impulse. Money without emotion does not remove risk, it removes distortion. It allows you to see allocation clearly, to think in decades instead of weeks, to build systems instead of reactions. When emotion no longer drives your capital, time begins working with you. And when time compounds uninterrupted, wealth becomes a byproduct of discipline. If this changed how you see money, subscribe. Like this if it clarified something.